good evening. Yeah, can you hear me? And welcome to PACE, welcome to Lumen School of Business. For those of you who are outside guests, again, welcome to the university. For those of you who are students and alumni, nice to see you here. I just wanted, on behalf of everyone, I welcome you to the business plan competition. I can tell you that you get some good panelists over here to judge you. Having done it myself in the past several times during my 30 years of business experience, I'm glad I don't have to do it anymore. And I look forward to hearing what you have to say. I certainly want to thank MIT Enterprise Forum and Bruce Hockenheimer for all the work he's put into this, and Lori Smith, the partner of Proctor, for putting all this together. So with all that, I think I'll turn it over to Lori. Look forward to hearing.
Hi. Before we get started, I want to get a sense of who the audience is tonight. How many of you are students? Okay. And how many of you have already tried to start a business or in the process of starting a business? Anyone who's an investor in the audience? A few, okay, good. Well, those of you who have been keeping track of what's been going on, it looks like things are looking up, at least here in New York for entrepreneurs. In some recent data compiled by Pricewaterhouse, Thompson Financial, and the National Venture Capital Association, for the first quarter of this year, there was $7.1 billion that was invested in venture capital, which is finally up from last year. It was about $6.3 billion last year, but not as good as the heyday that we all remember. There was about $26 billion in the first quarter of 2000. So what does that mean for all of you, and what do business plans fit into all of this? That's what our distinguished panel is going to talk about tonight. I'm going to start by letting them each give you a short introduction on who they are and what they do. Howard.
Hi, I'm Howard Morgan. I'm a lapsed academic. I used to teach at the Wharton School and then got into helping entrepreneurs start companies. I've done that. I do that now at Idea Lab out in Pasadena and with First Round Capital in Conshohocken, Pennsylvania and New York. And I basically invest in companies at two stages, too early and way too early. Try to help nurture ideas and people into what we could hope become great businesses. Probably done about 150 of them over the last 25 years. And some of them have been quite successful, and some of them have gone under. And we've seen the whole gamut, as it were. And some of them have started at business plan competitions, just like this.
Hi, I'm J.B. Lockhart. I work with Greenhill SADP. We're in the early stage venture arm of Greenhill & Company, which is a boutique investment bank. We focus on Series A investments, usually 1 to 5 million, do about 100 million under capital. And we're primarily focused on tech-enabled and information services, mostly in the New York area. Prior to Greenhill SADP, I worked in Disney and I worked at Lehman Brothers, both on the investment banking, M&A side, but also on kind of the corporate venture side. So I've seen both sides of that aspect of venture capital.
Hi, my name is Sang An. I'm a principal at Dawn Treader Ventures. We're a $300 million fund based here in New York. We manage really portfolio companies that are seed and first round investments. And I would say a plurality of our investments are on the West Coast. We like to invest nationally, but we do look very specifically at the Northeast. We focus on internet and software and what we call digital media investments. We have been in business since 1998. We manage 2 funds, and we have had a number of opportunities to look at software and services-based companies, but I would say most of our successes have been based on what I would call scalable internet-based businesses, and we are really focused there. But prior to coming to Dawn Treader, which was when I came in 2000, I was a management consultant and focused on telecoms, pharmaceuticals, and financial services.
Hi, my name is Fred Aslan. I'm the Vice President at Venrock Associates. Venrock started off as the venture arm of the Rockefeller family, and then today it's a diversified global fund managing approximately $2 billion. I would say that 2/3 of our investments are in technology and media, and 1/3 is in the life sciences. We're investing out of our latest fund, which we just raised last week, called Venrock 5. It's a $600 million fund. We have offices here in New York, Cambridge, and Menlo Park. And in terms of my background, I primarily focus on the life sciences investment. I was originally trained as a physician, and I've spent a few years at Boston Consulting Group, and then I spent a few years at a biotech company called Purigen, where I did business development, strategy, and finance.
Okay. I'm going to start by reading the panel a paragraph from a recent article in the Wall Street Journal to get their reaction to this. There was recently a study released by Babson College which analyzed 116 businesses started by alumni who graduated between 1985 and 2003. Comparing success measures such as annual revenue, employee numbers, and net income, the study found no statistical difference in success between those businesses started with formal written plans and those without them. Do you agree with that? And what do you see as the value of a business plan to an entrepreneur?
Well, I'm not surprised that they found no statistical significance because great businesses can be great in any way. But as a venture capitalist, I talk about what I want to invest in is 6 Ps, and one of them is starting off with the people. And there's people, products, plans, profits, passion, and persistence. Let's talk about plans, because that's what the question is. Having some idea of planning is very critical. You have to be able to have a vision for the business that includes the ability to see what's the business model, can that business model be made to work. That said, so many things change and change the plans along the first year of business that even if you have a very detailed plan, it's probably gotten thrown out or modified so much that the original one isn't what actually gets the business plan. So it's probably a valid compliment.
Well, I mean, for what it's worth, I mean, I think you're right from a statistical standpoint. I mean, I think there are companies that, I mean, the venture capital curve is such that there's only a few companies that make the gross majority of the return. So from a statistical standpoint, I think you could probably show that those might have had business plans or did not. But I think the real value of a business plan is it really hones your thinking. You put down all your thoughts on paper, and as Howard says, I mean, it's going to change 100 times. But also as you go through the process and you're talking to potential investors and potential partners, you really start sharing ideas, and that's where I think you get some great feedback. I mean, just going through the investment process, you actually probably learn a lot about your business and start thinking through where the real holes are, where the real advantages are. Besides, you can make a lot of great connections through potential investors as well. And in order to have a very productive discussion with investors, you really need to have a business plan.
The business plan for me is really, it can live in the form of a document, or it can really be an organized set of thoughts in your mind. Ultimately, whether you have a conversation in person with an investor or whether it's presented by way of a paper plan, the plan just has to be very succinct and answer some very basic questions, similar to what Howard was getting at, which is what is the problem you're looking to solve? What is the pain point? Who does the pain point affect? How many people does it affect? i.e., how large is the market? What is your particular solution to that problem? How are you positioned to execute and solve the problem? And if you don't, I think as an entrepreneur, have clear, succinct answers and thinking around each of those questions, whether it's presented formally in a plan or in a discussion, it's not a very productive conversation. So to the extent that's presented in a plan, great. If it's not, then it just depends on the avenue by which you get to the investors, really.
Yeah, I agree. I just want to echo again the fact that most of the investments that I can think of, in Venrock's history that were successful, they ultimately ended up being something very different. This is not to say that the original idea wasn't a very good idea. That's why, people put in the money to begin with, great people around it, but they do change. But really, I think, as you mentioned, it's really a way for you to actually get some time to speak with a venture capitalist, because there's so many people seeking venture capital financing. That business plan really is sometimes the 5-minute decision that somebody will be able to make on whether they want to take that follow-on meeting or not. So it's very important for that to be really crystal clear what it is you're trying to communicate, because that's your avenue to get in there. If you have an opportunity to do more brainstorming with a venture capitalist and have something that's a lot more engaged, then again, you have other opportunities to demonstrate that. But sometimes that's your only chance to actually get a chance to talk to someone. So it's really important that it's very crisp and clear.
How much time, though, do each of you really spend? If you get a 30-page plan from some comes in over the transom, actually reading that, or is it better for the entrepreneur to spend some time honing down on more of an executive summary or a short piece that really targets the key issues and focus on something the saying said, what are those really key issues that you're each focusing on in determining whether to sit down and talk?
Well, the New York Angels has a one-page format, which we also use at first round. No, if I get a 30-page plan in, I'm not going to read it. Particularly if it's over the transom. If it comes from somebody very close to venture industry who says you got to look at this, then I might. But 30 pages is well beyond my tolerance for most of these things. But I will start with a good executive summary, one page, which has the elements that were mentioned here. You know, what's the problem you're trying to solve? How big is the market that addresses? So is it big enough in scale to make it interesting? And can there be a venture return from it? Because it may be a wonderful business. I've seen a lot of plans over the years that will make actually wonderful businesses, but they're not venture type businesses because they're local or they can't scale up to anything that would be likely to be an IPO or a very high value exit. I'll start with that. I'm sure that's an answer stuff.
I would just add that a lot depends, the quality and length of the plan really depends on who the source, the referring source is. So in other words, if someone that is a friend of our fund who we trust and respect and is an industry leader tells us that this is someone you should meet with, an executive summary is more than adequate because we have sort of the implicit backing of someone who we trust. On the other hand, if there's an introduction from, let's say, not an industry source, some more information would be helpful, but I would say that if you can't get across the answers to the questions that we proposed in 3 or 4 pages, it's really hard to move on and continue reading.
Yeah, it's interesting because as embarrassing as this is, we also have a submission system where people submit business plans through the website, and I'm usually the one that gets them when usually they get submitted to the healthcare group. And generally the way that works is, I spend at least 50% of my time not in the office. So I'll be on a bus, on a shuttle terminal, all of a sudden an email pops in saying, here's the business plan. And usually they'll write a summary. This is what the idea is. Usually, sometimes it's the only amount of time I have to spend on that summary, what's on that email, that one paragraph. So it's really important for that paragraph to really capture what it is that you're doing, because that'll get me to read the executive summary. And then really the executive summary is going to get me to read the rest of the plan, which I agree is actually very important if it's in an area that I actually find to be interesting. Because right off the bat, after I read the executive summary, I will know whether there's a fit. And the way I'll know that, again, is based on, we look at, dozens of business plans every week. So we have a feel for which areas are the areas that are interesting. So I can read a one-page summary and have a pretty good feel as to whether this is an area that we would be interested in. And depending on whether it's very clear from that page that the rest of the plan is worth all my time, I actually will spend the time to read the business plan. Maybe not all 30 pages, but 15 pages or so to come up with some decision. So it's incredibly important for you from the very first paragraph that you write to make sure that you're communicating what it is. Because a lot of times people spend a lot of time on the 30 pages and then they just write whatever on that introductory paragraph, but that's the paragraph that I'm going to be reading first. So it's very important to continually increase the interest level so that people can go all the way through to the end.
I just want to emphasize one point that was mentioned here, is that our fund is relatively small, with only 100 million under capital, under management. But we probably receive a few thousand business plans a year, and we invest between 5 and 7 companies in that year, and so everyone kind of alluded to it, but having a warm introduction is incredibly important. So outside of even the business plan, having a warm introduction, if you can go through a friend of the fund, or through an advisor, or through someone who knows someone, or through a fellow board member, you have a tremendous advantage. You can get your foot in the door in order to submit that executive summary and then the full business plan.
Sort of jumped ahead to my next question. Really, everyone was talking about, and I purposely put those words over the transom into the question.
Apologies.
Really, for this audience, which is mostly students, how do they get to those people to get the warm introductions? Any suggestions?
Well, obviously the professors will get the people, the attorneys and accounting firms who know a lot of venture capitalists and work with some early stage ones will often give their time. Getting at competitions like this so that they can try to figure it out. We we had 671 business plans submitted in Q1, that first round. I think we funded 3. And that's probably more than most funds would have done in that same group. So it is incredibly tough. The 3 that we funded all came through warm introductions. But some of the ones that were not, that were really over the transom, we did in fact pass to other people who might be more suited for them. And I don't know if they got funded or not, but I think sort of work your way through into the system by trying to figure out who else might know the venture capitalists. Look on our websites, look at our portfolio companies, see if you know anyone in any of those companies who could then make the introduction.
Sure. I mean, it's a relatively difficult thing to get to people you don't know, but I would start with the service providers. You know, law firms who you have researched who do a good job of working with venture capitalists in the area are often great referral sources. Accounting firms as well. Startup companies that are portfolio companies who may have partnerships, and just getting out in the industry and making sure you can meet as many people as possible. The warm introduction is incredibly important in our firm, as I'm sure it is with the rest of the folks here. It really helps us cut down the amount of time we sit through deals. And a warm referral, particularly as a trusted source, really goes a long way in terms of our viewpoint on the plan. So that's an incredibly important aspect.
Yeah, so I completely agree. The other 2 things I would say is, one is how warm is the person. The way you're trying to figure this out is a lot of times we rely on those folks, it's based on their judgment. They're people that have a lot of experience with the investment business and the kind of selected promising plans. If it's, a former CEO that knows sort of what cutting edge technology is or what business makes sense, then that's a very warm introduction. If it's somebody that we happen to know, but it's not necessarily in the business, it's just somebody that you happen to know, then again, they're a little bit less warm because you can't really rely on their judgment right away. You have to do a little bit of the homework there. So trying to think through, who are the right people is one thing to keep in mind. The second thing is, spending time to find, those warm folks in firms that you are pretty confident that would be firms that are a match with what you're developing. And I don't know if you all know this site, this database called VentureSource. But I find it an incredibly helpful resource because it lists basically all venture investments that are made for the most part, and it has descriptions, amount of capital that these firms raise, an idea of how big these funds are. It's very important for you to know whether to begin with a fund is likely to invest. For example, if you have a business that requires $2 million for break-even, there's no point submitting it to Venrock, for example, because we cannot make investments where we're going to be investing less than something like $10 to $20 million, because otherwise we just can't deploy the capital that we have. So matching the size of the opportunity with the fund, particularly in areas that you know are going to be of interest to that fund, is one way to prioritize where you should try to find these contacts.
I'm sure these entrepreneurs have heard a lot about needing to have projections in their business plan and thinking about valuations before they approach the VCs. How important are projections to you, and what do you really do if you want to share the secrets in terms of valuing an early stage business?
Well, know that you understand how to do projections is important. If somebody on your team understands how to do them, it's important. If we had a machine that would turn spreadsheets into reality, we'd all be very, very wealthy. What we do is we split the revenue between 1 and 3 quarters and see how much money you're really going to need to operate the thing. And we want you to understand cash flow because that's much more important than GAAP financials in any of these plans. So it's important as a starting point. But the key, and I think it was mentioned here, is how much is it going to take to get to break even, which may be over 2 or 3 rounds of financing. So we have a sense of whether or not it's something that we should play in. Because first round capital typically it begins investing at the $250,000 to $500,000 level. But we know that most businesses take a lot more than that to get to break even. So we have to have a sense that we can work with other firms and raise the 2, 5, 10, 20 million that it may take a set of projections that understands that.
Yeah, I think it's less important what the specific numbers are. It's far more important what the underlying thinking is about business economics, really understanding how the value chain plays in your certain industry, what the potential business models are, and then kind of on an aggregate level, kind of market size. So if you really thought through market size, and you really thought through the business economics and what the splits are and all those, then I think then we can kind of work on the financial projection ourselves to get a sense of the size of the opportunity. But the actual numbers themselves are not as important. It's kind of more the underlying thinking behind it.
Yeah, I would agree. I think for us, financial projections are so fluid that they're really a sort of watermark test of the experience level of the team, really, because for financial projections that are clearly stated with assumptions for what will drive the projections and drive the revenues, and the well thought out, clear thinking behind those projections really demonstrate a certain level of thinking and experience that a less clear, less assumption-based model would really show. And so it's really a test to see how, it's an indicator of how experienced the team is and how sanguine they are about what those assumptions can do. And the other point I would add is that we like to see, base case, best case, worst case. We like to see, what happens if, projections aren't met? What is the downside case? What happens if you're wildly successful? What happens in the upside case? We like to see that. And finally, I would say it's really important for us in the early stages to understand for your next milestone, whether it's a fundraise or break even as a business, what does it mean if you need to do $4 million in revenue to break even in a business that only needs to break even at $4 million? What does that mean? How many customers do you have to have? How many salespeople? Give us a sense of how much you have to accomplish. Because if your break even is $4 million, but your sales points are $25 a customer, and you need 20 million customers to reach that, it gives us an indication of how difficult it is to get to those benchmarks. So those indicators are more important to us than the actual absolute numbers.
Yeah, I agree with all that. And then just out of curiosity, though, because it's a little bit different in the biotech and medical devices space. Is anybody here interested in biotech or medical devices? All right, so it's very different in biotech and medical devices because, as an industry, it's still unprofitable, right? So when you're thinking about an early startup in biotech, the revenue projections is not really as important as, basically the market size. Because, hopefully you'll have made the investment, you'll have stuck with it for 7 years, and you'll have exited before it even started generating $1 in sales. That's generally the trend in biotech. So that becomes a lot less important when you're thinking about a business that is, 10, 15 years away from generating revenue.
The one thing I would add is that what we always ask for, particularly in a consumer business, is what we call unit economics. Tell us about selling one product, one copy of the product, or one sale on your website. What are the economics of that? And it's amazing how many entrepreneurs never think about that. And it's, and when you force them to look at it, they say, "Oh, I guess we're losing money on that single sale," and it's not that we make it up in volume kind of thing. So you really have to understand the unit economics, understand the margins, to get at the point that doesn't take 20 million of you before you see anything. You want to know about valuations too?
Valuations too, if you want to share that.
Well, evaluations are, in the very early stage, they're is supply and demand. For a couple of years, 2004, 5, 6, there was very little supply of capital. We could value things very low. Now there are more firms chasing deals, they get valued higher. There's no intrinsic valuation for most of the companies we see. The basic rule of thumb is we want to understand how we're going to make 10 times our money and how we're going to have a chance to make 50 or 100 times our money. And if we see that your exit is going to be $100 million exit, then we can't invest it higher than 10 million post money to get 10 times our money. So we work backwards from the returns that we need to make it an interesting deal for the venture cap, for the investors and the venture capitalists, which is different than any intrinsic value measures might have.
I would add that if you're submitting if you're going through an investor presentation with an investor for the first time, and especially if it's your first institutional round, I definitely wouldn't come in with a valuation expectation, and definitely don't put it in writing, because a lot of people actually do that, and that's going back to the comment before about talks about kind of the caliber of management and the management's experience. I mean, that is a clear sign that the management has not gone through this kind of process before, and might not be have the greatest expectation or have the most reasonable expectations of somebody you work with. So once again, it's a very fluid process, but I think you need to be open to it to kind of feel out where the market is in terms of valuation.
Yeah, I mean, the other thing I would say about valuation is I think that this point about supply and demand is a very important one. Oftentimes, people that are a little inexperienced don't have a lot of contacts in venture. They end up developing a relationship with maybe one group of venture folks, and then as that relationship proceeds, the venture folks know that they're the only people that are considering the deal, and oftentimes that's at a disadvantage to the company because there's less, I guess, supply for that same business plan. So one advice is always try to talk to as many people as possible. A, because it'll put you in a better position, and B, because you'll learn a lot more from talking to different people. The other thing to think about is, when it comes to valuation, is we always try to think about valuation as trying to create enough ownership so that the investors are engaged and there's an upside for them, as well as giving the entrepreneur enough of a carrot that they're incented to continue working really hard to make it work. And really, we feel that if you follow that basic formula, nobody's trying to be too greedy on one side or the other, it generally works out. The other thing to think about is if you're the entrepreneur who's going to be, working with the company, and technically you're going to be receiving employee stock options and so forth, your ownership stake is somewhat protected and it'll keep going up. So you can have faith that a lot of times as the company matures and there's further dilution that you may be a little bit protected. If you're just a founder and you're going to be handing this off to another team, then this is another story, right? You have to focus on a business that's more capital efficient because you're likely to get, even further diluted as the process goes on. So it's really important to think about these things and not just rely on the process. Sit down with someone that understands how ownership changes as the company matures, as more money comes in, and figure out what it's going to look like for you under different scenarios. That way, you're better prepared to explain to someone why you need more or why you need less, as opposed to, I just want more, which is normally what people ask for.
I want to talk a little bit about the interaction between the various capital sources, angels, VC funds, strategic investors. Howard sits on a couple of these sides of the equation. Big problem I see with a lot of early stage companies that come to me is they've obviously put things together with toothpaste and spit it for a while, and they've got, they come in with 50 people who've already invested $1,000 each. How do the VCs view the whole capital structure when they come in?
I would say that the most important thing for us with capital structures is that there has been a past demonstration of productive use of capital. If you raised $50,000, we just want to understand what you've done in the intervening time. If you raised $1 million, what have you done with that money? And that is an incredibly strong indicator for us for what you plan to do with the money that we plan to invest in. Investments that come in through angel investments are a really great source of deal flow for us because it means some qualified group of individuals believe that there's something here, and that initial capital to a good entrepreneur can be used to great advantage to create enough traction, production quality, at least beta quality software, some initial traction if it's an online business. It gives you an opportunity to do quite a bit to show that you are on a trajectory to be successful. And so we're really receptive. On the other hand, if the capital structures are incredibly messy, it becomes a problem. In other words, if there's 3 rounds of angel investments, all different prices with different liquidation preferences, a first institutional investor like us, and many of us on this panel, will want to have no problem with having a junior class behind us, but really simplicity and a clean capital structure is important, primarily from the perspective of this company, if it is successful, being financeable in the future, so that the next round investor isn't burdened with a very complicated structure.
Yeah, our fund has a great relationship with Howard, New York Angels, and we see a lot of deal flow through them. It's fantastic. I just want to talk a little bit about the strategics you brought up. Having worked at Disney and Lehman on both the strategic venture side, both cases, it depends what stage your company's in. I mean, having seen it from that side, honestly would be very wary if I were an early stage company of taking strategic capital. You can, limit your future customers, other competitors in space. You can limit your exit opportunities. They oftentimes have a very different view of what the company should be doing, and their incentives aren't nearly as well aligned as a financial investor. Now, I mean, later, maybe when you're a few rounds in, you've already had a proven business model. At that time, it can be very advantageous to take strategic capital. But early on, we see this occasionally that early stage companies sometimes feel the necessity or are kind of tempted by the, having this great channel by which they can put their product through by having this great strategic investor. But at least from my personal opinion, if you go in too early with strategic capital, it can be a real problem.
Yeah, I mean, my word of advice is to really think carefully who the angels are going to be. Because if there are people that are very different to work with, a lot of times they'll have a lot of say on what happens with the company. And if they don't happen to work very well with the VCs, it really may put the whole business in jeopardy. I can think of one deal that I was involved with recently where this was a medical device deal that had an angel that came in. He obtained maybe 20% ownership into the company. And then, the company pitched, they basically did a lot of progress. They pitched the company, a couple of years later to venture capital. People were ready to invest $20 million into this company, but they didn't want that angel on the board. He had some provisions in basically in the term sheet that basically gave him the ability to choose as to whether he would leave the board or not. And so because the venture folks just found him too difficult to deal with, they ended up not investing in the company because of this angel investor. So it's very important to make sure that you're getting someone that you think is reasonable, will think through things together with you. They're not likely to be at odds with you in the future, or they're likely to be at odds with people that you may have to do business with in the future.
We often have to clean up capital structures where you have, issuances that may or may not have been completely kosher as far as the securities laws, particularly lots of friends and family money and so on. And it's one more barrier. It means that if you need a 90 score essentially to get by our filters, that's going to take a few points off. So you have to make it up somewhere else for us to want to go through the pain of going to those investors, doing what's needed to either buy them out, put them in a cleaning class, and do all the work. So fewer investors, that is to say 10 or fewer, is a lot better than getting dozens. If you're going to go to friends and family.
A couple of people talked about the team. At what stage do you really put together the team, and what do you think you need in place before you would make an investment in a company?
Well, the team is not just the inventor. I mean, there's typically a founder and inventor. We want in place a person or people who have the idea, the sort of core idea behind the business, and we want, if that's a technologist, which it often is, we want a business partner for that person. Somebody that they have worked with, can work with, that can do all the things that need to be done when you're starting a business. That's kind of the minimum set for us.
Yeah, I mean, I think it depends on what stage you're investing in, what the team should look like. On the earlier stage, yeah, you definitely, obviously, a founder who is oftentimes on the tech or operations side. But we see there are a lot of companies that we are in the process of investing in. And I think one thing that actually venture capitalists bring to the table in terms of value is the recruiting. We have pretty good networks. And so VP of sales, CFOs, we oftentimes help the company recruit that management. And and I think that's one thing you really get out of an investor. But you really do want that CEO who's kind of the lifeblood of the company to be there at least for a while to grow that company. And that's really what you're investing in, more so than just the idea, is that CEO and that that core management team that's founded the company.
Yeah, I mean, the way we look at it is the right people at the right time, and we don't have unreasonable expectations of having a complete management team together on day one. It rarely happens that way. But what we do like to see is, a founder, if he's technical, he or she's technical, then paired up with a business partner and vice versa. We just want to see that there's a mix of skills and management experience at the table to get to the next level. And if the company is successful and can execute, there's often very little problem acquiring additional talent and recruiting additional people. I would say on the negative side of things, if we see a plan that comes in the door and it's a Series A pre-revenue company, but the entire team has been filled out with very senior executives at all sorts of posts that really don't need to be there, it's really sort of a mark against the entrepreneur just because of the lack of judgment to sort of spend the money and capital really at the wrong time. Another example is if a company is incredibly dependent on a channel for sales and a direct person is hired too early in the process, there's questions of why that happens. So people selections are really important, but I think most VCs are very reasonable and accommodating when it comes to not having a full team, but it is important to have the right people on at the right time.
Yeah, so I think keeping an open mind that you may not be the best person to take the company forward. Very oftentimes we will find a founding team with some individuals that are pretty good, but they wouldn't be the ideal team to take this company forward. It's very important for the entrepreneurs to realize that they're an asset, but at the same time they can be a liability if they're not really used at the right role. I mean, usually, speaking from the life sciences side, a lot of times you're taking a lot of risk on the technology itself. You don't want to take a risk on the management because there's enough risk that's being taken on the technology. So it's important for you to take a step back and say, what are my strengths and how does it compare with other people that are great for this specific area? And I think there's a role for the initial founders and the entrepreneurs, particularly kind of carrying a lot of the heavy weight in the beginning. But as sort of things move forward, it's important to keep an open mind. And I would say that's probably the top thing that venture folks do. Because at the end of the day, the biggest asset that we have are the people that we know, either entrepreneurs that we backed in the past, people in large companies that we've met throughout the years. We have a very extensive network of folks. That's probably the best thing we bring to the table. So actually come to us asking for help like that. But the caveat is, if you're showing up for the first time to a venture group, it's important to have at least one person in that group that has enough credibility that when they're presenting that information, they have the credibility for us to know that they know what they're talking about, right? If it's somebody, that, for example, if it's somebody that has a science background but hasn't necessarily developed that specific technology, that's not good enough, because how do we know that this entrepreneur knows what they're talking about? I mean, you need to have at least someone that's extremely credible for what they're presenting, and then come to us for help in terms of rounding out the team, because that's what we can do.
Once they get past the first filter and you decide to sit down and talk, can you give any idea as to what the usual decision-making process is like? What a normal timeline would be from that first meeting to a term sheet, and from term sheet to actually getting money, and what the diligence process is in between?
Agonizingly slow for the recipient is the timeline. It depends so much on how well prepared things are, whether or not there's competition. I've seen term sheets turned around in a week because somebody comes in and says, well, firm X, Y, or Z is getting ready to give us a term sheet, and if you can verify that through some back channel, and you don't want to lose a particular deal. But normally it's a 3-month process. And part of that 3-month process is seeing how you react under pressure and under the time pressure. Due diligence involves reference calls, reference checking, lots of questions, several meetings.
Yeah. I think funds vary in how much diligence they do before term sheet and after term sheet, so it's a varying process. Some are pretty liberal with giving term sheets, and then sometimes they back out. I think predominantly firms generally don't like to do that, and because it goes around the investor community and the entrepreneurial community. But you definitely do go through a diligence process where you might make those few key customer calls, those few key management references, and then you really think through kind of the market size and all these other things. And I think once again it goes back to the point which Howard just made, is like, how good are your documents? How well are you prepared? And the more prepared you are, the faster it's going to go. So I think that's just kind of, and it also has to do with, quite frankly, other things we have on our plates too. But can't really handle that.
Yeah, I would agree with the sentiment. I think most firms, if put under duress with competitive terms, you can move 4 to 6 weeks at the absolute max speed. I think generally speaking, the process is really closer to 2 to 3 months. And for just in terms of process, what you can expect is when you walk into a firm, you may have an initial meeting with an associate and/or partner. I think there's always going to be a follow-up meeting to learn more. And after that, there's going to be some period of time where the company and the investor do some work together to figure out whether this is an opportunity. And if it is, then there's often a partner meeting where the company comes in and meets with the entire partnership. And some firms vary at that point. It's a fairly developed process, and other times what it means is that the partnership agrees that this is an interesting enough project for them to really put in the full court press on the due diligence. So a lot varies, but at the end of a due diligence period, there's often a term sheet and there's negotiations. The way we look at due diligence is we like to be thorough as we can be, because we're doing pre-revenue companies. There's only so much you can look at in many cases. But often it's an opportunity for us to work with the CEO and entrepreneur. And we learn a lot about how an entrepreneur handles questions, his or her thinking process, how they handle very strategic questions, personnel questions. You learn a lot about their thinking process, and that in of itself is really helpful for us. If we happen to be in an industry that we've already done a lot of work in, we've met 10, 20, 30 companies, that due diligence process is usually very fast. If it's a brand new field, but we think it's promising, usually it's a little bit longer.
Yeah, I think that's a very important point. Like how well we know the area really will determine how quickly, we can do the diligence. I mean, just thinking back about my experience, the fastest deal that we went through was like a 7-day deal, but this is because we do both private investing as well as public investing. We literally had 7 days to commit to making a $5 million investment in a public company. And the longest one is a deal that I'm still working on, that I started working on it last July. Why has it taken so long? Because, initially we were going to start with a couple assets, but then, one of them dropped out, so then we were looking for another one, then we identified a CEO, that CEO ended up not wanting to go through. So, it's a process, it can take a while, particularly if the company is not baked yet. You're actually baking the company together with a venture capitalist. So it's important to be patient. And the other thing I would say, just from your perspective, the way you know whether the momentum is building is whether there's more people in the firm that are getting introduced to the deal. Because if you're just dealing with that one associate for, 3 months and nobody else knows about the deal, then, chances are either that's appropriate because you're still working up the deal, collecting the right information, and not all is there, but at least it gives you a good feel, because generally there will be an investment to other people within the team, at least at Venron. I'm sure it's true from other places since we work as a team in those places. That'll be a good process for you as to whether there's momentum that's building up. And the other thing I'd say about momentum, a lot of times, we take the time to read the business plan, and then the more we start reading about an area, we start getting excited, right? So I'll be introduced to something that I wasn't really thinking about, and I'm reading about it, I'm getting excited about it, I'm reading about it at night, over the weekend, and I'm hoping that momentum starts to build up. So then I have follow-up questions, follow-up things that I want to do. If for some reason then the company takes a while to get those in place, or doesn't really, act in a very quick way, then all of a sudden I start to lose my momentum because now there's other things that came through, and then it can be difficult to kind of get the momentum back. So it's very important to be as responsive as possible, because again, I promise you that on the other side of the phone, people there are spending a lot of time trying to understand it so they can sell the idea to the rest of the people that they work with.
This might be an unfair question for this panel, which is very tech-related, but we reviewed a bunch of plans coming into today. At least one of the finalists was very low-tech or non-tech. Where do you go for money outside the tech? Do any of you have suggestions?
Well, the New York Angels, while about 70% of our investments are tech, there are a few that are not tech. We looked at soda companies, beverage companies of various kinds. We looked at candle making. We're kind of a little bit broader. And, it's harder for those companies to get a lot of investor interest, only because most of our members don't have a lot of experience in those fields. But that is one place that you can come. NewYorkAngels.com, there's a submission form and so on there.
Anyone else? You're taking off the non-tech. Okay. Well, let's turn to the business plans we reviewed, since we only have a few minutes left here. Without necessarily identifying one plan or the other, can you highlight some of the strengths and weaknesses that you saw in the plans?
Well, I think one strength that I saw across all of them, they all did a very good job of looking at the general market and doing a lot of research and kind of trying to size the market in many different aspects. I think that was a clear strength to all of them. I also think that they all leveraged the strengths of the management team. They were all playing a core competency of the management team. So I think that's a great thing. I mean, clearly, you're only going to do very well if you really start a business in something that you know a lot about. On the con side, I think it varied according to the business plan, but it goes back to kind of our fundamental point, which was making the value proposition very simple, clear, and concise and succinct early on, and just really spelling it out. Because once again, we don't tend to have a lot of time. We're going through so many of these, and frankly, I mean, I'm not that smart. And so in some areas, you know, I know a lot about things, but a lot I don't. And so really understanding that value proposition clearly up front, who the clients are, you know, if there's going to be suppliers, who those are, and then kind of highlighting who the big competitors and big players in those spaces are. And so we can really understand very quickly, you know, what exactly the business plan's about and where the real value is.
I think one thing I found was that the notion of who the competitors are is important, and I think it came through in some of the plans. Because the last thing I like to see is a plan where these people basically say, we're the only, or the first, or the unique. And I already know about 2 other plans that I've seen in the last month that are doing exactly the same thing. And really research that. And I think that did show through on the positive side of a couple of these plans.
Yeah, I thought the plans were really well written. There was a lot of information. I think the one problem is what was referenced earlier, which is not having a succinct enough kind of value proposition in some cases early on. We by virtue of being committed to this panel, we went through the plans in probably more detail than maybe if they had the 3 random plans. But having an early, very clear description of what are you solving is so important. And for us, for me in particular, it's important to understand, who's a customer and what are they getting exactly. In a lot of these information technology-based businesses, it's very easy to just launch into jargon and launch into techno-speak. And what I often like to ask is, if I were to buy one of those that you're selling, what would I get? What do I get? Are you selling a product, a service, a product with a service? What am I getting? And that's really important for me to understand up front. But otherwise, I thought it covered, in almost every case, all the major aspects of a good business plan. But again, to an earlier point, if you don't have that value proposition clearly outlined early, it's hard to really move on and read more.
Yeah, and I guess the only other thing I would add is it's important to, it's tough in a business plan competition because the people that are reading your business plan, depending on what kind of business you're pitching, it can be very varied, and the people that are reading it are also have pretty varied backgrounds. So you have to basically try to develop something that will cater to everyone, but not necessarily to anyone. But in general, you're going to be pitching to very specific people. If you have a very technical business plan, chances are it's going to be going to somebody that has that technical background. If you don't, you don't. So, again, reading them the way I did, I felt like it was very useful for me to read the ones that are in areas that I don't know as much about, because I felt like I really understood what was coming across. But the one in biotech, for example, I would have appreciated actually understanding more in detail what it is that the company does, because it outlines, for example, the different opportunities in the space. But again, because I know what these technologies are, I want to know exactly what the technology does. So it's important for you to provide everything that somebody evaluating your plan would want to see. So again, catering to the right audience is very important.
Does anyone in the audience have any questions at this point?
In the last few years, we're seeing sort of an explosion, a re-emergence of the incubator, things like Y Combinator, Techstars, in Europe now, incubators which take very novice teams, bring them in for 12 months, put them through a curriculum, get them into a product, some kind of invention. Is this different from previous incubator activities? How does this fit into investing? Is it pre-angel? Does it go to Series A? Is it addressing a very specific segment of the market, like the technical invention versus general business approach? What's up with these incubators? Because they're really moving now, it seems.
Well, having been a founder of Idea Lab, which has been very successful and continues to do incubation, I think what's up is we went through a period where there are 2 kinds of incubators. There's incubators that are real estate plays, and there are a lot of those where they'll provide real estate and so on, but not a lot of additional help. And then the internet today, which allows you to start a business with very low capital, has spawned Y Combinator, which has done really well. And of course, since it's done well, we're seeing a lot of copycats trying to do the same thing. Whether they'll be successful, it remains to be seen. Y Combinator makes you live in student conditions for another 3 months, basically. But the success rate is not high from Y Combinator. It's just that the successes in this business can be very big. And so for the Y Combinator founders and for those people who are in the successful ventures, things are great. You don't hear much. It's called, survivor bias is the statistical term. You don't hear much about most of the Y Combinator trials, which don't work. And so an incubator is a kind of a hard taskmaster. And Y Combinator takes 3 months, and then they decide whether or not it's going to make it or not. Now, I think that's a good way for people who have a modest amount of time to commit, the ability to commit the time and get into one of them to work. I think we'll see more incubation, particularly because of low capital needs. When we started Infinitics in '94, '93, really, we needed about $5 million to get the thing launched. We started Half.com, we needed about $1.5 million to launch it in 2099. When we started Video Egg, which is quite successful now, we needed $250,000 to launch it. And that has just changed the economics and allowed Incubator to flourish again.
Yeah, the only other thing I'd say is a lot of venture groups, I feel, are beginning to go a little bit early, and they're willing to actually do some incubation in-house. For example, I can think of one venture firm that every year they'll actually seed fund 30 companies. This is a large fund, and the idea is that maybe 5 of them will succeed, and then they'll do a proper Series A. And the reason they do it is because these days it's so difficult to find really good Series A deals that sometimes they feel like they have to go a little bit earlier and take some of that risk ahead of time so they can jump in. So that's another alternative. If you're open-minded about approaching a group and saying, I have this idea, but it's kind of half-baked, but with 250K, this is why it would be huge if it worked, and if I spent this much, this is what I think I'd accomplish. I think even some venture firms would be open to that if they fall in love with the idea.
Our firm, we do incubate a few deals, I would say, every 2 years. Usually they're companies that come in through very close friends of the fund who have ideas. And we have, for example, a company we sold last summer to Microsoft. It was an incubated company. The fund started out with a 30% ownership along with the founder. And so we've done a few of those, and we will continue to do so. But we have no formal incubator program per se. We don't really quite understand beyond the good deals that come in what else we would do with the other ones. The other form of incubation, which maybe you might consider a soft form of incubation, is what we see with successful entrepreneurs. So, for example, we have an entrepreneur we've invested in who has been very successful, and he's started a bunch of companies on his own, and has successfully incubated 3 or 4 to the next level to raise institutional money. But those are all his companies, his founding teams. He owns an ownership stake in every one of them, and he happens to be well off enough to purchase real estate, have them all housed in the same building, and as they progress, they move on to outside investors.
Any other questions?